Hi guys, I hope you're all okay. Once again, we are meeting for this live session, and yeah, it is lunch break. And on this lunch break, I just decided, you know what? Let me share this concept of financial management with my good students on YouTube, right? So I know your exams. We are in August. By the way, happy new month. I know the exams probably are in counting from today. We are talking over like almost 20 days, right? So how good are you prepared with these revisions? How good are you prepared with these revisions? How good are you prepared with these papers? It is an exam, a professional exam. And yeah, it is always tested in a sense that is a professional exam. So today what I'm doing, uh, basically I'm introducing financial management revisions. For those who are interested in, of course, joining our revisions, I'm going to attach the WhatsApp link just below this video, or rather in our chats. I'm going to attach that WhatsApp link so that at least you can join the WhatsApp group, and it will be very easy now for us to communicate, for us to set classes, and for us to always basically what? Meet. So at this point, I want to introduce this revision by handling a specific question. And this question, basically, you'll find that it is an area that I know also probably majority of the lecturers, they normally tend to ignore. But it is a very key concept that if at all you're having it at the back of your mind, it will be very, very easy. So what you're doing, I'm sharing this question with us. It is a question from our block model paper. I'll wish us to check it out. And as at the end of the day, I know we are going to learn. So basically, this is what I am sharing, believing that it is visible. Yeah, let us study, guys. There is a class basically just to do some revision for some of the basic concepts that you must understand from the back of your mind. And therefore, in that case, I'll focus more on computation as much as also theory. Remember, it's also very important. I'm not telling you guys to ignore the theories. The theory does summarize, they're giving you a summary of Q&A, the theories Q&A. Kindly make use of the theory Q&A to do your revisions. So we are going to start with question number 1 in our class today. That is in our model paper, question number 1, basically part D. And I'm just going to share a question here. I'm going to share this question of us here. Part D of the question. I believe you can clearly see the question. And this is what you're told in this question of ours. This is what you're told that BD Limited expects a return on investment, that is ROI, of 24% on proposed investment projects, whose total cost is 5 million. In order to finance these investments projects, the company is considering 2 options. So at this point, I'm expecting a return on investment of what I'm given there, 24%. And in this case, I'm given that for us to attain that, the company has 2 options. Number 1 is to issue 500,000 ordinary shares at a par value of 10. Number 2 option is to issue to 50,000 ordinary shares at a par value of 10 and obtain the balance through a bank loan at an interest rate of 15% per annum. The rate of corporation tax is 30%. So the question here wants us to determine the effect of the 2 financing options on the earnings available to shareholders, and hence advise the company on the best financing option, So given such a question, my good students, you'll find that basically you should identify, first of all, the area that we are being tested. You should identify the area that we are being tested. So on this case, we can clearly see that the question, or rather the examiner, at this point, you want us to advise the firm. And of course, we'll be advising the firm based on the impact of our investments in our earnings per share. So, because you are an investor, yes, you've invested somewhere. Of course, you're going to count this investment based on what you're going to earn. And recall, at this point, it is very vital that we should always remind ourselves on how to determine our EPS. Anytime you're talking of earnings per share, basically what should come at the back of your mind is NOPAT, that is net profit after tax. Talk about net profit, that is, of course, net profit. That is NOPAT. Talk about net profit after tax. NOPAT, net profit after tax. We are going to divide all this, of course, by our number of shares. Number of shares. This will give us what we're referring to as earnings per share. That will give us what we're referring to as earnings per share, whereby you'll be talking of NOPAT, that is a net profit after tax, we divide by the number of shares. And because I'm also dealing with the return on investment, it is also very vital that we should understand that anytime we are talking of, of course, of our net profit, or rather, anytime you're talking, of course, of a return on investment, because the examiner had given us a return on investment, right? Or the company should be earning. Return on investment, you should always have in mind that basically we normally tend to talk of profit before interest, profit before, of course, tax and interest. We divide all this by total assets. Total assets, or rather total net assets. Total net assets. In other words, you're talking of what? Capital employed. Capital employed. Capital employed. This is how we normally tend to determine our return on investment. And many a times in advising our investors, key element that we should always have in mind is that we normally tend to advise our investors based on either earnings per share, whatever that you're going to earn in our investment, or the aspect of return on investment. So given this question, and clearly you've seen how we can determine our EPS as well as how we can determine our return on investment, the other good question that you should ask ourselves here is that the examiner wants us to find out, determine the effect of the two financing options on the earnings available to shareholders, and hence advise the company on the best financing option. So in such a case, my good students, it will be very, very important for us, first of all, to know our profit before tax and, of course, interest. Before tax and interest. Before tax and interest. Were we given our profit before tax and interest? Because remember, for me to achieve my net profit after tax, I need to have our profit before tax and interest to deduct our tax for us to have that. So my good question is, in our case, is there any place where we are given profit before tax? I'm not seeing anywhere we are given profit before tax. I'm not seeing anywhere we are given profit before tax. But if you're not given, should we stop there and say that this question is halfway? No. Look at this case. Because you know very well that in advising, we should always be focusing on either EPS or return on investment here. You'll find that our good examiner here has given us our return on investment. Return on investment that the examiner has given us, he has given us what percentage? Return on investment, the examiner here has given us 24%, right? So we can take 24%, with that is what I'm given, into what? Profit before tax. So you're given somewhere profit before tax. I'm not given profit before tax. So in this case, I don't have profit before tax. What about capital employed? How much are we investing? How much are we investing in this question of ours? How much are we investing? You can clearly see that we were investing a figure of how much. You're told that on prop. BB Limited expects a return on investment of 24% on proposed investment projects whose total cost is 5 million. So capital employed, I should be talking of what? 5 million. This is what I'm going to invest. So having that case, my good students, clearly at this point, the good question that we should ask ourselves is that whenever I'm having this, can we determine what is our profit before tax? Profit before tax and the interest, profit before tax and interest. This is just profit before tax and interest, right? So therefore, we can agree that my profit before tax and interest, I should be talking of 24% here times 5 million, which, my good students, this should give us how much? Where's my car? Let me pick my car and see what we'll be having. I should be talking, of course, of 0.24 times 5 million. In this case, I'm talking of what? So we can agree and say that my profit before interest and tax, we are having a figure of how much? We are having a figure of 1.2. That is what Mwalimu is getting. So this is where our starting point should be, determining our profit before interest and tax. That is where our starting point should be, determination of our profit before interest and tax. Once we have determined that, let us proceed and see now our proposed, or rather the proposed investment plan that we had. So alternative one, we issue 500,000 ordinary shares at a par value of 10. That, of course, should give us 5 million, the one that I'm expecting to have, right? Then the other case, we are told that we need to issue to 50,000 ordinary shares at a par value of 10. Then in that case, we obtain the balance, through a bank loan at an interest rate of 15% per annum. Okay, so I want us to erase here. I want us to erase here so that I can clearly show you the best way that we can work this one out. So allow me to erase this point here, because already we have determined our key concept. We've determined our profit before interest and tax as 1.2. That is what you've agreed, right? So in this case of ours, let us see these workings. In this case of ours, let us see these workings of ours, the one that we had. Number one, we've said that looking at these options of ours, looking at our options. So option one, actually, let me have this. Let's just do it in summary form. So I'm having option one here. We're having option one, or rather alternative one, and alternative two. Okay, I want to have it in a very summary form so that you should all understand. Alternative one, of course, in this case, our profit before interest and tax will just be the same profit before interest and tax. I'll just be having the same 1.2 and 1.2, the figure that we just determined, right? Then from that case, we identify our interest. Before we deduct our tax, of course, we must always deduct what? Our interest. In option one, we don't have any interest. What about in option two? Option two, this is what we are told, that we are going to finance using this option, whereby I'm going to issue ordinary shares, ordinary shares, you're going to issue ordinary shares, 250,000 at a par value of 10. This should give us 2.5 million, right? The rest, you're going to finance it using what? Loan. This loan, of course, you're talking of 2.5 balance. For us to attain, of course, for us to attain the 5 million. For us to attain the 5 million. But you are told that this loan of ours will attract an interest. This loan of ours will attract an interest at the rate of what? At the rate of 15%, right? So it should be the rate of 15% times 2.5, which in this case, therefore, my good students, you can agree and say that my interest amount, we should be talking of 0.15 times 2.5, which in this case should give us a figure for much, my good students, 375,000, right? This will be our interest. That would be our interest. That would be our interest, 375,000. So the moment we do have that case, we can agree and say that option two will have an interest of 375,000, which we will be required to deduct at that point. So that my profit before tax, on the first case, I'm going to have 1.2, alternative one, or rather option one. Option two, profit before tax, I'll be having the 1.2 minus 375, which in this case should give us 825,000.
I believe up to that point we're together. I believe up to that point we are on the same page. We are on the same page, right? Now, once we have that case, we proceed and see what else will we be having. We proceed and see what else will we be having. We need to compute our tax. In tax, you're given a total rate, 30%, right? So what will be our tax here? We need to compute our tax component, tax rate. Tax rate, of course, I was given 30%. So therefore, on the first option 1, I'll be having 1.2 times 0.3, which will give us 360,000. Option 2, 825,000 by 0.3, this should give us 247,500. So therefore, as at the end of the day, my good students, what will be our profit after tax? Profit after tax and interest, the first one I'm having 1.2 minus 360, which would give us 840,000. The other one I should be having 825,000 minus 247,500. This should give us 577,000. 577,500. I believe up to that point, you are still on the same page. I believe up to that point, my good students, we're still on the same page. Now, once we have that case, profit after tax, that is our profit after tax. So, can we determine our EPS for the two companies, earnings per share, and see what we'll be having? So my earnings per share here, our EPS, which we said we should be talking of no part over the number of ordinary shares, That is what we've agreed. We can note and say that option 1, which is alternative A, so option 1, or rather option A, alternative A, whichever case that you can take, I'm having my EPS to be, I should be having a part, which is 840,000. How many ordinary shares are we issuing, my good students? Option 1, you're supposed to issue 500,000 ordinary shares, right? What about alternative A, or rather option B? Option B, my part is 577,500. And you're supposed to issue ordinary shares of 250,000, right? So you can agree and say that our EPS for option A, I should be talking of 840,000 divided by 500, which in this case I should be having EPS of 1.68 per share. Earnings per share, I'm going to have 1.68 per share. 1.68 per share. Whereas for the other option B, 577,500, divided by 250,000 here, that should give us 2.31 per share. 2.31 per share. So what is the impact on the earnings of, our shareholders? What do you think? What can we advise? Of course, in this case, which financing option should we recommend? Of course, in this case, we can recommend this firm to go with financing option 2 or B, financing option 2. So where financing option 2, you'll find that at that point, since it will have a most favorable impact on earnings per share, because you find that investors will be earning 2.3 per share compared to option A or investment 1, where investors will be earning 1.63 per share. So therefore, we can agree and say that this company should go with option, or rather should go with option 2 or B, where the investors will be earning 2.31 per share. So basically, that a question can be set in such a manner whereby you need to advise these investors on the best option to go. So the NSR will say that basically, remember, on advising, we'll be talking of concept of earnings per share, or we can talk of return on investment, the ROI. ROI. So that is always very key to understand whenever we're talking about advising our investors. So that is what you're required to do in that question. So thank you so much. Next, when we meet, let us meet and handle part D of the question. Let us meet and handle part D of the question. So, guys, I hope you enjoyed that session. That was just introductory bit of financial management revision. As I've mentioned, if at all you are interested to join us on these revisions, I've mentioned that if you're interested basically to join us in this revision, of course, you can always reach us out. The WhatsApp link, I've literally attached it on, I've literally attached the WhatsApp link on this video. You can also basically get in touch with us on our number, that is 0708 068851, so that we can assist you guys. Up to this point, I wish you all the best, and I hope you're going to join our revisions so that at least we assist you the best way that we can to make sure that all of us, we've passed this exam and we've basically enjoyed. Yeah, to that point, see you then, guys. Have a lovely